Today, we are diving into the absolutely incredible story of Schneider Electric Infrastructure, or SEIL. It's a fantastic tale of a company that went from being this struggling, capital-heavy business to a tech-driven powerhouse right at the center of India's massive energy revolution. So let's break down exactly how they pulled off this amazing transformation. And really, that's the big question we're tackling today. How on earth does a company drowning in losses and high debt not just survive, but completely reinvent itself to dominate its entire sector? Well, the answer is in this multi-year turnaround that is frankly nothing short of remarkable. And this side, wow, it just says it all, doesn't it? Take a look at the left side. Back in fiscal year 2017, a staggering net loss of 176 crore rupees. Now look at the right. What's happening in fiscal year 2025? A record net profit of 268 crore. The contrast is just night and day, and it really sets the stage for everything we're about to get into. All right, so let's dive into the first act of this story, the financial comeback. We're going to look at the hard data, the actual numbers that fueled this incredible recovery. Let's start at rock bottom. Back in FY17, the company wasn't just having a bad year. It was reporting huge losses. Even its operating profits were in the red. This number right here, a net loss of 176 crores, really underscores just how deep the hole they had to climb out of was. Okay, now let's fast forward. By FY25, the picture has completely flipped. We're looking at a net profit of 268 crores. Now, this isn't just about getting back into the black. This is a powerful statement about profitability and just top-notch operational excellence. That massive swing is the heart of this whole turnaround story. Now, what's so cool about this slide is it shows you the whole journey. You can literally trace the consistent upward march. Yeah, revenue more than doubles from 2017 to 2025. That's great. But look at the operating profit margin, the OPM. It goes from a negative 10% to a super healthy positive 15%. That, my friends, is where the real magic is happening. So, you might be wondering, how did they do that? Well, the answer is a powerful concept called operating leverage, which I like to call the profit slingshot. Think about it like this. Over 5 years, their revenue grew at a solid 14% a year. But, and this is the key part, because their fixed costs were covered, their profits grew at a mind-boggling 59% a year. Every extra rupee of sales had this huge outsized impact on the bottom line. And while all this was going on, SCIL was tackling its other massive problem, its debt. This chart shows a really dramatic improvement. The debt-to-equity ratio dropped from 1.55 in FY24 all the way down to a much more comfortable 0.78 by late 2025. They were systematically getting rid of what was once a totally crushing burden. And all of that hard work culminates in this one standout number, a return on equity of 74%. I mean, for a heavy electrical equipment company, that is just exceptional. It shows you how incredibly efficient the company has become at turning shareholder money into profits. It's a huge reason why investors are so excited about this stock. Okay, so that was the financial recovery. Pretty impressive, right? Now let's look ahead. Let's explore why CIIR is so perfectly positioned to just keep on growing by literally powering modern India. You see, SEAL's future growth isn't just some wild guess. It's anchored to 4 massive, unstoppable trends in the Indian economy. We're talking about modernizing the entire electricity grid, the digital transformation of every industry, the absolute explosion in data centers thanks to AI, and building out all the infrastructure for electric vehicles. SEAL is smack dab in the middle of all of it. This chart here shows us how they're making their money. The systems business, that's their core equipment like transformers, is the biggest slice. But the really crucial part to watch is the services segment. Right now, it's 17% of revenue, but it's a super high-margin business that management is laser-focused on growing. That should give their overall profitability another big boost. Now, let's just zoom in on one of those pillars for a second, the data center boom, or what we can call the AI flywheel. As AI and cloud computing just take over everything, the need for data centers is exploding. And every single one of those data centers needs incredibly sophisticated power distribution infrastructure, which, guess what, is SIL's specialty. They are a dominant player in this space. So, what's their secret sauce? What gives them the edge? It's their digital platform called EcoStruxure. The best way to think about it is like the digital brain that makes all their hardware smarter. Just like this quote says, it's this IoT-enabled system that gives customers real-time data and even predicts when maintenance is needed. This is huge because it transforms SEL from just a hardware seller into a strategic partner in energy management. Okay, so the financials are awesome and the growth story is totally compelling. But this always leads to the big question every investor has to ask. Okay, this sounds great, but am I paying too much for it? Let's dig into the valuation. This really is the million-dollar question, isn't it? The stock has had this incredible run-up. So the fear is all this good news already baked into the price? Is it too late to get in? A fantastic way to answer that is to put it side by side with its competitors. Here we've got SAIL next to giants like ABB India and CG Power. Now look at the PE ratio. At around 58, it's actually cheaper than CG Power. But the real story, the jaw-dropper, is the ROE. At 74%, it's more than double its closest competitor. That tells you that while you might be paying a premium price, you are getting dramatically superior performance for your money. And that brings us to one of the most revealing numbers of all, the PIG ratio. At 0.50, it is well below that 1.0 mark that analysts often use as a rule of thumb. What does that mean? It suggests that even though the price seems high, the company might actually be undervalued when you factor in its incredible growth rate. The high price might be more than justified by even higher profit growth. Now, another tool analysts use is something called a discounted cash flow model, or DCF. I know it sounds super complicated, but the idea is actually pretty simple. You just try to forecast a company's future profits. Then you discount those future profits back to today to account for risk, and that gives you a rough idea of the company's fair value. For SEIL, this kind of analysis points to a fair value somewhere between 517 and 810 rupees per share, really just depending on how bullish you are on their growth. All right, so we've seen the incredible comeback, the powerful growth engine, and the case for the valuation. So let's wrap all of this up by looking at the potential risks and delivering the final verdict from the source analysis. Look, no investment is a sure thing, and it's always smart to be clear about the risks. For SEL, the main things to keep an eye on are, can they actually deliver on their massive order book without hitting bottlenecks? How will interest rates affect their remaining debt? Will they face payment delays from some of their state-owned clients? And finally, could intense competition start to squeeze those healthy profit margins? These are all things to watch. So, after taking everything into account, the final verdict from the analysis is a hold or accumulate on dips. The company itself is fundamentally fantastic, but the stock might just be taking a breather after its huge run. The recommended buy range is between 585 and 610 rupees, with a 12-month price target of 950, which still represents some pretty significant potential upside. You know, SEAL's story is just a powerful tale of revival. It's a real testament to financial discipline and brilliant strategic vision. But as we've seen, the real excitement is all about what's next. And so the final question we're left with is this. If the last chapter was about revival, is the next chapter going to be about absolutely explosive market-defining growth? Based on everything we've looked at today, the answer could very, very well be yes.